Welcome back, students who are taking financial accounting, and this is going to be the last video for the series of videos for Chapter 1, the short exercises. And let me just jump right down to the last slide there. All right, here we go. And as always, if you don't understand something, watch the videos again. And if you still don't understand something, feel free to speak with an instructor, either via telephone or contact us via email from your My Courses page. But anyway, so let's get on to 1-14 here. Right? It says transaction analysis and calculating net income. Right? The analysis of Cunnings Inc.'s first 7 transactions follows. The business only sold stock once and paid no dividends. So it had 7 transactions here. Right? Label each of the transactions in the preceding analysis with the corresponding letter of the description that best fits it. All right. So A is earned revenue for services provided, but customers will pay later. B is customers paid cash for services completed earlier in the month. C, received cash for revenue and earned by providing services. D, paid cash for expenses incurred to operate the business. E, paid cash to purchase equipment. F, sold stock to start the business. And G, purchase equipment with a bank loan. Right? And then number 2, it says, if these transactions fully describe the operations of Cunnington Inc. during the month, what was the amount of its net income or loss? Okay, now before I get started, I'm getting to a point where even though this is just basic and fundamental, okay, and these are just, it's the first chapter, we're only thinking about transactions and categories of accounts and things like this. We're already at a point where I'm not going to be repeating an awful lot of the stuff that I, would start with or, I would talk about before. I'm going to start skipping some of the more fundamental things like, okay, assets, we increase our assets on the debit side, right? This is stuff that we should already know, all right? When we increase our liabilities and our equity on the credit side, so just realize that as we go forward, I'm going to start skipping some stuff because I have to be introducing new information, and what was 15 minutes would now end up being a half an hour. So I'm going to start assuming that you know certain things. Okay. Right now, for this exercise, and I had alluded to this, well, not alluded, I had said in other videos that I don't like the idea of the expanded accounting equation, right? I mean, technically it works, but it confuses issues because why? On our balance sheet, we have our accounting equation. Assets is equal to liabilities plus equity. And that's what you have right here. But if you notice number 2 here, it's going to be talking about net income. Okay, well, where do we get the net income from? Well, that's on our income statement. Okay, that's our revenues less our expenses gives us our profit or loss. Okay, so that profit or loss is our net income. Now, I had in previous videos, as a quick overview, I had said that when we first start out our accounting period, our accounting equation is in balance. Our assets do equal our liabilities plus owner's equity. And as transactions occur, as long as we're only affecting asset accounts, liability accounts, and equity accounts, our accounting equation stays in balance. But as soon as we use a revenue account or an expense account, that throws um, our accounting equation out of balance. So in the beginning of the period, we're in balance. We have transactions, which we post to our journal, which we create in our journals. We make journal entries, right? And then we post to our general ledger accounts. Right? When we post to the general ledger accounts, all right, we can create a trial balance, which is nothing more than a listing of the ledger accounts and the balances in those accounts. Now, if all we look at is our assets, liabilities, and equity accounts, we'll find that we're out of balance because we used revenue or expense accounts. So as part of at the end of the month, we create this trial balance, and we have to bring, we have to, one, create financial statements, and two, bring our accounting equation back into balance. So in order to be able to bring our accounting equation back into balance, we have to make closing journal entries. And when we do, this profit or loss, this net income, gets put to our equity account, and that equity account is this retained earnings account. And when we do that, that brings our accounting equation back into balance in order to start the next accounting period. That's the way I like viewing it. That's the way the books happen in the real world. With the expanded accounting equation, what we have is we have assets is equal to liabilities plus equity plus revenues minus expenses, and if you pay out dividends, minus dividends. Okay. And if you're, as we're sitting here and we're looking at this, what we see right here is we only see the accounting equation. And notice, here in the equity section, we don't have, the consideration of the expanded accounting equation of profit or loss, but yet we're being asked what our net income is down here. So I'm, what you see, and you have to, what you're looking at right here. Remember, when working through word problems, when working through these exercises, you have to bring, and this is the whole point behind everything I've said so far for the last 8 minutes, is that you have to bring all of this knowledge from the back of your head. You have to have it back there, okay? You can't look this stuff up in the book, because if you're trying to look at net income here and you're trying to go into the chapter and see an example of this in the book, you're not going to see it, okay? You're not, in the book, yeah, you see the expanded accounting equation up here, but you don't have that here, all right? And you're trying to work with this material. If you don't understand the concepts, you're not going to be able to apply them, all right? And you're not going to find it in the book. So by my working through these exercises and things, hopefully, through some amount of attrition or osmosis or whatever you want to call it, you'll see me doing it, and you'll see my thinking behind it, and hopefully you'll retain some of that, okay? So that on your own, you can develop the skill set of being able to keep the things in the back of your head and know when to pull them as tools when needed, right? So for number 1 here, okay, so it says label each of the transactions in the previous and the preceding analysis. So I have to label these transactions here with one of these, okay? So what am I looking at here? All right, for number 1, I have an increase in cash, 40,000 in cash, so I've increased my cash, and I have an increase in my common stock. Well, when I look down here, this is earned revenue, so that's not it. Customer paid cash. Well, we're not paying cash, we're getting cash. Right, so we received cash for revenue. Well, we're not dealing with revenue, we're dealing with common stock. Paying cash is not it. Paying cash, sold stock to start the business. Sold stock. So we're talking about stock here. And if we're selling stock, that means we have an increase in our stock, right? And we're receiving cash for it. So number one is the letter F. Okay. All right. So F is gone. All right. So number two. Okay, we have a decrease in cash of $6,000, meaning we're paying it out. Okay, and we're increasing our assets by buying equipment. So we've increased our equipment from 0 to 6,000. So we're actually buying a piece of equipment, and both are assets. So earned revenue, nope, because we're not dealing with revenue. Customer paid cash. Well, we are paying cash for services completed. Well, we're not performing services, we're buying equipment. We're receiving cash, no, because we're paying it out. Paid cash for expenses. Equipment is not an expense. E, paid cash to purchase equipment. So this would have to be E. Right, number three, we have an increase of $15,000 in equipment, and instead of paying cash for it, we're taking out a loan, a note payable. Our note went from, we didn't owe anything before, and now we owe $15,000. So we increased our note payable. We increased our liabilities in order to be able to purchase the equipment. So I'm just going to skip past those first four, and we go down here to G. It says purchased equipment, which is what we're doing with a bank loan. So number three is G. Right, number four, we have an increase in our accounts receivable and an increase in retained earnings. Right. It says here, earned revenue for services provided, but customer will pay later. All right, so if the customer is going to pay later, that means that's on account. And on account means it's going to be there on a receivable if it's a customer owing us, or accounts payable if we're purchasing from a vendor. All right, and so for this one we are earning revenue. Okay, now here's why I don't like this this expanded accounting equation concept, because we don't have any revenue here. If I didn't know that on my income statement I have revenues less expenses to give me profit or loss, and that I have to, at the end of the accounting period, I have to take that profit or loss, or the net income versus or net loss, right? Just as a quick aside, net income is the same as profit. Net loss is the same as a loss. Okay. If I didn't know I have to take that net income and close it out to the retained earnings account, I wouldn't know that this is what this earned revenue would be for this particular situation. Okay. But it is, because earned revenue is part of our income statement, which is net income, and we're closing it to retained earnings. So earned revenue for services provided, but customer will pay later. So the customer's paying later, the account's receivable, and we're increasing our retained earnings because we're increasing our revenue. So number four is A. Okay. All right. Number five. Okay, so we have a decrease in our cash, means we're paying out cash, and we're decreasing our retained earnings. Okay. So customer paid cash, that's not us. We're the ones paying the cash. Received cash, no, can't be that, because we're the ones paying. We're not receiving cash, we're paying it. So it has to be D. Paid cash for expenses incurred to operate the business. Right? So 5 has to be D. And again, this goes to the same exact thing as number 4. Expenses are on our income statement, and the expenses on the income statement provide the profit or loss. So revenues will increase our retained earnings, and expenses will decrease our retained earnings. And since we're paying out money, we're decreasing our cash. So number 5 has to be D. Okay, a decrease paid cash for expenses, decrease in retained earnings, and um, a decrease in our cash. All right, number 6. We're increasing our cash by $17.50, and we're increasing our retained earnings. Okay, so again, all right, customer paid cash for services completed earlier in the month. All right, received cash for revenue earned by providing services. Right, customer paid cash, which means we're receiving cash, and it's saying here received cash. Okay, so it still could be, from the cash perspective, it could still be either B or C, but what's the difference here? It says for services completed earlier in the month. Well, if services were completed earlier in the month and they weren't paid for, that means they would have had the services on account, meaning we would have made a sale and we would have had an accounts receivable because we were extending, credit to them earlier in the month. All right. So now if they're paying cash, they're not paying for the services. They're paying for the what they borrowed, what was on account, the accounts receivable. And we don't have that right here. Okay. So it can't be B, it has to be C, where, we're receiving cash, which is this increase of our cash by $17.50, for revenue earned by providing services. Revenue earned is sales. Sales is on our income statement, which increases our profit or loss. And when, this is just like number 4, okay? Since we're increasing our revenue, we're increasing our retained earnings by $17.50. So 6 has to be letter C. And the thought just quickly occurred to me, for those who are, by process of elimination, saying, okay, well, I have either a choice of B or C. Now like in this case here, 7 would be B, and I don't have to really think about it. Don't do that, okay? Because this could have been mixed up any other, number 7 in a different problem could have been number 3, all right? And you'd have to go through the thought process. Finish out the problem. Don't just say, oh, B is left, and that's what number 7 has to be. Think through it, because there's a learning experience right there, all right? So number 7 is an increase in cash by $350 and a decrease in my accounts receivable. So what does that mean? We're paying off the receivable, which is what I just explained, in doing number 6. The customer paid cash, so we're receiving the cash, but services were completed earlier in the month. If services were completed earlier in a month, we would have a debit to accounts receivable, right, and a credit to sales, right? That's earlier in the month. Why accounts receivable? Well, one, we're making a sale. That's the services completed, right? But, we're going to think through the process. Did I receive cash? No. If I don't receive cash, the second question I ask myself is, am I affecting accounts receivable and accounts payable? Yes. It's an accounts receivable because it's to a customer. And if I'm increasing my receivable, I'm increasing my asset, and that's a debit. Okay. And then debits have to equal credits. So I have to look, for another account to credit. And since it's services completed, well, I'm making a sale. So that's revenue. So I would put it to a sales account. So that's my earlier journal entry. But right now, I'm taking, the customer paid cash for services completed earlier in the month. So right now, for the journal entry, am I affecting cash? Yes. So I'm going to increase my cash, right? Now I have to look for the opposite. Well, they're paying. What are they paying for? They're not paying for the sale, okay, because that transaction was already recorded, right? What they're paying for is the accounts receivable that they had incurred. the receivable increased by 350, went from 0 to 350. And so right now they're paying that receivable. So my credit would be to accounts receivable, which is what we have here. Okay. Right, so that's the thought process through that, right? Now, number 2, okay, it says if these transactions fully describe the operations of the business during the month, what was the amount of the net income or loss? Okay, so what's the amount of the net income or loss? Well, this is relatively, relatively easy. But then again, I'm using the storehouse of knowledge that I have before. Here's the expanded accounting equation. And remember, revenues, expenses, and dividends, right, all affect our equity, our retained earnings account over here. So if I want to know what my net income or loss is, all I have to do is just look at my retained earnings column and add up and subtract. Remember, when we have revenue, we're increasing our retained earnings, and when we have expenses, we're decreasing our retained earnings. Okay, so what do I have here? I have 1200 less 1350 plus 1750. If I add those all up, well, that's 2950 less 1350. That's $1,600 is my net income. Okay. All right. So I hope you got that. All right. Revenues and expenses go on the income statement, but they're closed out to the retained earnings account. Okay, so to answer this question, even though I don't have a revenue and expense column here, I just need to look at the change in my retained earnings in order to know what my net income or my net loss was. Now notice what I just said, because this is going to happen to you again in this textbook, on other problems. Notice what I just said. I said it's the change in the retained earnings. Okay, if I have an accounting period, and let's say my retained earnings was $23,000 at the beginning of the accounting period, right? And let's say my retained earnings, remember on the statement of retained earnings, you have a beginning date with a beginning amount, and you have an ending date with an ending amount. Let's say it's $25,000 at the end. Okay, I can take my ending less my beginning and see the difference between those is $2,000. I know that's my profit or loss. Why? Because what was on my income statement gets closed out to my retained earnings, right? Now I'm not taking, in this brief example, I'm not considering dividends, okay? I'm just, that's just a separate issue here. But just to be able to decide, what my profit or loss is, all I have to take is the beginning, my ending less my beginning in order to determine the profit or loss without actually having to look at the income statement. In a previous video, we showed, in the introductory videos, I was showing the relationships, okay? And everything is about relationships in the financial statements, all right? Aside from doing analysis on it. But you don't need to have, all the information presented. With accounting, again, it comes back to understanding and application. And you have to end up deriving a lot of the information that you need, but it's all there. You just have to be able to know the concepts and to be able to apply them at the correct times. All right. So with that said, that's the end of the short exercises. And again, watch the videos again. If you don't understand something, feel free to contact an instructor, and I will see you for the regular exercises.